Thank you for being here. Very pleased to report another quarter of good performance, solid all-round performance by the company. And before we get into the details, the disclaimers about the forward-looking statements that we could be making in the course of this interaction. The highlights of the performance very clearly during the quarter 3 ended December 31 was the all-roundedness. I mean, we were able to grow our order book, we were able to improve our revenue significantly, we grew our EBITDA margins very well, and consequently the profit after tax as well did very well in terms of growth percentages. The only sore point, if at all, is that the incremental orders that we were to pick up in Q3 declined by 12% as compared to the Q3 of the previous year. But it's good to bear in mind that when we look at 9 months performance, as we have been speaking to you in the past, the order inflow has been fast forwarded in the current year, and that was expected and planned. So we picked up significantly large orders in quarter 1 and quarter 2. So we had the cushion of larger orders into our kitty during the 6 months period that was able to absorb the decline of 12% in Q3, and yet at the end of 9 months we are ahead by 16% on a year-on-year comparison basis. And you will recall that we had put out a guidance of 10 to 12% growth in order inflow for the period FY19, and given the fact that we are plus 16% as of December, at least puts us on good course to stay within the guidance that we had given out earlier this year. The order book for the 9 month stays at 5% growth, and the revenue for the 9 month, unlike the quarter which grew by 24%, is up 22%. EBITDA is up 31%, and profit after tax is up strongly by 31%. Speaking about the order inflow for the quarter 3 ended 31st December 2018, the company won orders worth 422 billion rupees, which is in comparison to the 482 billion rupees of the previous year's third quarter is down 12%. The feature of this quarter has been the 22% decline in the domestic orders. Last year in Q3 there was strong surge of domestic orders, and actually last year it was only in Q3 and Q4 that the order inflow warmed up and picked up pace. And so consequently we had a robust Q3 in the previous year. But in comparison, the current quarter, even though 307 billion rupees is still a very significant order win for the quarter, looks 22% lower. On the contrary, the international orders improved in this period by close to 30%, from 88 billion rupees to 115 billion rupees. And despite the volatile international environment caused by the socio-economic turbulence, the economic sanctions, and the safeguards, the duty safeguards, and obviously the geopolitical tensions, we've been able to sustain in the markets that we are operating our interest and our clients' interest, and hence we were able to grow our order inflow by about 30% in Q3. For the 9 month period, we've crossed 1 trillion rupees. The total orders that the company has won for the 9 month period is 1.2 trillion, which is up 16% as compared to the 1.03 trillion of the previous year. Unlike the quarter 3, the domestic order for a 9 month period records a growth of 20%, from 762 billion rupees to 912 billion rupees. This is largely on the account of the order wins earlier this year. The international orders have also grown in this period, but more moderately than compared to the Q3 situation, where it's grown by 10%, from 272 billion rupees to 291 billion rupees. The order book consequently, as of 31st December 2018, stands at 2.8 trillion rupees, a growth of 5% over the 2.7 trillion rupees, and nearly 80% of the order book is in the domestic market, and with the balance in the international markets. The orders that we have picked up during the course of the year largely comes from infrastructure. The investment momentum continues to be in that space. Consequently, our bids have been largely focused around the infrastructure sector, and so has been the order wins. Hydrocarbon sector has joined the party in this period. We've had fairly significant wins both in domestic markets and international markets. So nearly 13% of the orders that we have won in the 9-month period is from hydrocarbon sector. The services sector, where for statistical purposes we include the income earned by the services as orders placed on us to deliver those services, has grown handsomely by 20%, and that's a significant move up as the services business that we run in our portfolio begins to get stronger. The order book, which is 2.8 trillion rupees, has nearly 75%, 77% to be precise, in the infrastructure segment, followed by about 12% in the hydrocarbon sector. So much of the project work that we do, which carries on for a few years to execute and complete the orders into sales cycle, is largely resting between the infrastructure segment and the hydrocarbon segment. As you know, power segment has not been beneficiary of a lot of order flows, so they continue to remain modest. The revenues for the company, as a group, for the quarter 3 has been at 357 billion rupees, up 24%, and for the 9-month period is 961 billion rupees, up 22%. Quite close to the yearly number of 1.1 trillion for the entire year of FY18, the previous year. The share of international revenue has been around 33% for the 9-month period, and pretty much similar for the 3-month quarter ended December as well. The manufacturing, construction and operating expenses at 235 billion rupees for the quarter 3 is up 28%, and for the 9-month period is up 21% at 608 billion rupees. Since financial services business uses money as raw material, the interest cost that they incur is treated as part of the input costs early on in the schedule, and hence the cost incurred by the financial services business for the quarter is at 20 billion rupees, up 29%, and at 54 billion rupees is up 22%. It's worthwhile to bear in mind that the revenue growth far exceeds these percentages of growth, so consequently the profitability of the financial services business has improved, and you could see that later in the presentation. The staff cost at 46 billion rupees for quarter 3 and 135 billion rupees for quarter 9-month is up 20% for quarter 3 and 21% for the 9-month period. The increase is largely on account of the augmentation that we have done in our services business. As the services business begins to grow larger within the portfolio, it's a very people-centric business, so it is important for us to staff these businesses, the IT, technology services, as well as the financial services business, with the right kind of talent. The sales and administration expenses of the company, of the group rather, for the quarter 3 at 17 billion rupees is down 12%, largely because we are carrying far less credit cost in this period. The ECL provisioning across the businesses that we run and the credit cost of the financial services have been far lower and under significant control during quarter 3 as compared to the quarter 3 of the previous year. However, on the 9-month basis, the sales and administration expenses is up 11% at 57 billion rupees. Consequently, the total operating cost of the group at 317 billion rupees for the 3-month period ended December and 854 billion rupees for the 9-month period ended 31st December is up 24% and 20% respectively. EBITDA for the quarter 3 is at 40 billion rupees, up 27%, and for the 9-month period is 107 billion rupees, up 31%. The margins consequently have increased by 30 basis points for quarter 3 at 11.2%, and the EBITDA margin is up by 70 basis points for 9 months at 11.1%. The interest cost incurred by the group, excluding financial services, which we saw earlier, is at 5 billion rupees for quarter 3 and 13 billion rupees for the 9-month period, up by 48% and 16% respectively. The interest cost is higher in quarter 3 in line with the additional borrowing that the group had made during the quarter in question. The depreciation amortization at 4 billion rupees for quarter 3 and 16 billion rupees for the 9-month period is in line with the depreciation amortization policies of the company. The other income is up at 6 billion rupees for quarter 3 and 13 billion rupees for the 9-month period. It's up at 183% and 30% respectively. Much of the borrowing that the company raised to keep the liquidity buffer within the system, given the liquidity constraints that the markets were going through in October, November, December period, as you might recall, was actually not consumed in working capital but invested in safe treasury instruments. And that has been largely the reasons as to why other income has stepped up significantly in quarter 3. And this has to be seen in the context of the rise in finance cost as well. So it's, in a manner of speaking, treasury management to make sure the businesses have the requisite liquidity should liquidity get into some kind of difficulty for the system as a whole and not necessarily for the company. The exceptional items have nothing to be reported for quarter 3 and 3 billion rupees for the 9-month period, and hence the profit after tax for the group is at 20 billion rupees for the quarter 3 is up 37%, and at 55 billion rupees is up 31%. We now get into the segments and see how they have performed in terms of their revenues and profitability. And there are no changes to the segments that we had reported in the earlier quarter. Starting with the infrastructure segment, the segment has turned up a very strong performance. On the back of a 9% order inflow growth for the 9-month period, the segment converted very successfully the order book into revenues by progress on the execution of several jobs, and both in India and in the international markets. And we have a 24% raise in revenues of the segment for the 3-month period ended December at 182 billion rupees. And for the 9-month period ended December 18, the segment revenue grew by 19.2%. Out of the revenue, 47 billion rupees for quarter 3 and 128 billion rupees for the 9-month period is from the international business, roughly translating to about 25% of the total revenue. And the revenues from the international business has grown by about 5%, both in quarter 3 as well as in 9-month period, reflecting the execution pace in the international contracts. The EBITDA margin for the quarter 3 is at 5.4% for the infrastructure segment, down by 250 basis points on a year-on-year comparison for third quarter, and for the 9-month period at 6.3% is down by 130 basis points. The EBITDA margins largely reflects A, the state of the jobs that we are executing, B, the mix of cost jobs to revenue margin generating jobs, and C is the cost provisions that we have carried in the infrastructure segment, particularly the transportation infrastructure segment, the claims for which are pending with the clients for certification and approval. As and when these claims come in accordance with our accounting practices, they will be credited to the profit and loss account, whereas the accounting conventions that we follow has the cost accounted for it as and when incurred.